So let's have another look at the stock market performance over the last 5 years using the S&P 500. Do you see that there are certain time periods when the stock market has consistently performed well and certain times where it has consistently performed badly? These are two conditions that a stock market can be in. The market condition with all the consistent highs is called a bull market, and a condition with all the consistent lows is called a bear market. The naming of these market conditions, although quite peculiar, is quite straightforward to remember. Remember how bulls charge ahead and thrust their horns up in air in order to attack, and how bears claw down on the victims to charge and attack. So up refers to an up in the market, which is a bull market, and the clawing down of bears refers to a down market, hence a bear market. To be a bit more technical, when a stock market keeps performing well over time without falling for more than, say, 20% from its previous 52-week peak, that is called a bull market. During bull markets, the prices of securities continue to rise since investors are all pumped up about the well-performing market and continue to buy a lot more shares. When a stock market is in a bull market phase, the overall economy is also considered to be very, very strong. Cool. So bear markets, on the other hand, is when a stock market continues to fall in performance by 20% from its previous trough. So during a bear market, stocks follow a downward trend with falling prices, since investors who believe that the trend will prolong start pulling out of their investments. So during this phase, the overall economy is also considered to perform quite weakly. Now let's leave the bull and bear market concept aside for just a minute and focus on how the stock market reacts to the economic cycles themselves. As you know, the strengths and weaknesses of the underlying economy affect the performance of the stock markets as well. So what happens to the stock market during the various phases of the economic cycle is actually pretty straightforward. When the economy is strong and is performing well, businesses perform well too. They generate high revenues and high profits, and when businesses report great revenues and profits, the share prices increase in the stock market, causing an overall stock market or the stock market itself to perform really well. But when the economy doesn't perform that well and the economic activity slows down, the businesses in that economy suffer as well. So when the revenues and profits of the business start declining, share prices fall, that causes the stock market to also perform very poorly. This being the general way of how it all works, when there's an economic recession, the stock market typically continues to decline sharply for several months. For example, just look at the S&P 500 performance during the past 22 years. You can see two very low performance points. The first is in September of 2002 when the dot-com bubble crashed, and the second is in 2008 when the housing market bubble crashed, both of which are most recent recessions to hit the US. Of course, apart from the one which seems to be stirring currently. But what I'm trying to get at is stock markets respond very heavily to recessions, and more so to the anticipation of a recession. Historically, during a recession, the stock market performance has tended to do its absolute worst 6 months after the start of a recession, and has tended to pick up its performance even before the actual economy has gotten better. Now let's bring back the bull and the bear markets into the equation. We know that when the stock markets are down, it's called a bear market. We also know that during recessions, the stock market goes down. So if you put all that together, we can see when a recession happens, the stock market definitely goes into a bear market state. But be extra careful with your articulation here. When recessions happen, yes, the stock market does become a bear market, but not every bear market means the economy is in a recession. A bear market can mean an indication for a possible recession. But again, it doesn't mean that the economy is definitely falling into a recession. When bear markets do happen during a recession though, the decline in stock market performances tend to be a lot steeper than those without a recession. To be precise, among the bear markets that took place since 1946, the average decline of stock market performances with a recession was 35.8% versus 27.9% on average without a recession. All things considered, there is no denying that investing in stocks during a recession is super high risk investment. But like Mark Twain once said, October, that month is especially dangerous for investing in stocks. Other than months that include August, January, June, March, November, July, February, April, December, May, and September. In layman's terms, stock investing is risky either way. It's all about being strategic when it comes to being successful. Besides, as opposed to the general notions, recessions in fact do offer several investment opportunities for those who know where to look. So you might as well explore.